Hey guys, it's me, Sean James from 999 Capital. Thanks again for hopping in here with me again. We got a great video for you today, and I thought it'd be great to touch on the 2008 financial recession and its impact it had on silver and what that could mean today. So let's take a step back to the year 2008. You know, I was still a kid back then, so I don't remember too much, but what I remember, the only thing I do is chaos. People were panicking out of their minds, everyone was losing their jobs, banks were being brought down, and homes were being foreclosed too. At the time I didn't really know what was going on. But now, after doing some research, I think I finally understand. But it's important to know that the 2008 financial recession didn't just happen with the snap of fingers. It actually had a lot to do with preceding events, and it was about a 20-year process that led to that point. And two of the biggest factors that had to do with that was the tech bubble in the 90s and also President Bill Clinton. So I'll get to Bill Clinton a little bit later, but let's talk about the tech bubble first. So back in the 1980s, technological innovation was the hottest thing at the moment. I know Apple was just coming out with the new Mac computers, and it got everyone excited. This, of course, it put more money back into the economy. A lot of investors were seeing new tech startups as potential money-making machines. And that's how a lot of this economic strides were being made. It was booming, for lack of a better term. But the Fed, it intervened, and that's when things got crazy. What the Fed did, they lowered the interest rates to record lows. This allowed investors to borrow more money to invest into tech startups, grossly inflating the economy. You see, if there was no Federal Reserve intervention, it wouldn't be like that. There would be moderate rises in prices, and as a result, there would be moderate gains in wages too. And people would see that their quality of life and the quality of life would go up and the cost of living would go down. That's how a normal market economy works. But now it was so exasperated, so out of control. A tech bubble was just brewing down the pipelines. That's exactly what happened. Through 1995, the interest rate, the federal funds rate, I should say, it was 6%. 1996, it was 5.25%, and it just kept going down and down and down. And by mid-2000, that's when it became to a screeching halt. That bubble, it finally burst. And the federal chairman at the time, Alan Greenspan, his grand big idea was to cut interest rates even more. He made interest rates down to a record low of 1%. You know, his thinking was more along the lines of the Keynesian economics. They thought by inflating the money supply, more people would borrow, which would undoubtedly make more investments worthwhile, which would put more money back into the economy. That was their thinking. I don't personally agree with that, but that's what a lot of Keynesians do. And Alan Greenspan, he likes to use a lot of PhD lingo, and he could not see through that hubris that this kind of policy was exactly what got them in this situation in the first place. And that's where, inadvertently, that led to the 2008 recession too. This is where it gets really interesting. And this is where President Bill Clinton was involved. You see, back in 1995, he made a lot of changes to the Community Reinvestment Act. And the thing is, he said that everybody in America should be able to own a home. So he forced banks to lend out to these low-income persons. And the thing is, this is where he gets a little bit too full of himself. And this is exemplified by the fact that things done in social justice never actually provide desired outcome. That's exactly what happened. He failed to realize that low-income persons, they typically have terrible credit. And because they weren't repaying their loans on time, they sent it all back to Fannie Mae and Freddie Mac, these mortgage associations. What these guys did then, they repackaged these loans and they called it collateralized debt obligations. And they sold it to institutional investors. So CDOs, the collateralized debt obligations, they are asset-backed securities. And by asset-backed, what I mean by that is they're backed by the repayment of those loans. So let's say if someone defaults on this security, that means they get that repayment of the loan back to them. That's called credit default. But it didn't work like that. If no one is repaying on time, there's nothing to back the CDOs by, right? So that undoubtedly affected the market, which caused a lot of homes to be foreclosed, caused a lot of investors to lose a ton of money, and caused a lot of income inequality. And some of Bill Clinton's other policies also dramatically affected what would happen in 2008, such as lending out to low-income and minority home buyers at twice the rate of conventional home buyers. So that's a lot of stuff being lent out. He also spent billions of dollars to tear down 30,000 units of public housing to replace new ones, and he would send $1.44 billion to the housing and urban development sector of the federal government. Crazy, right? But don't just think that I'm picking on Democrats here, because Republicans are guilty of this too. President George Bush, he enacted the American Dream Equity Act, I believe it's called, maybe I'm mixing that up. But essentially that act would have made 40,000 people a year. It would have said you don't have to pay any down payment on the home loans that you take out. That's crazy. 40,000 people a year? Come on now. And unfortunately, that is what led to the 2008 financial recession. And that's where we are today. But how has this affected silver? That's the real question. That's why you're here. Well, typically, as I've mentioned in previous videos, when inflation is really high, that works to silver's benefit because it works as a hedge against inflation. But I'm going to read you a couple of stats here, and this is from the U.S. Money Reserve. Let me pull this up. So, at the end of August 2007, 4 months before the Great Recession, the price of silver had sat at $11.95 an ounce. And by the end of December 2007, it had jumped to $14.67 an ounce. And the peak price of silver, it hit $19.24 an ounce. At the end of February 2008, it decreased to $9.09. But wait a minute. I thought, and this is what common logic dictates, is that if the inflation is high, as we've seen, shouldn't the price of silver go up too? And we saw that for a little bit. So what happened? Well, the short answer, and this is the answer you're probably not going to like, is that they made it that way. The central banks have been suppressing the price of silver for so long now. It's no exception during the recession. They need silver to be low because it benefits their fiat currency system. You're starting to see how that works? But they're very smart about it. You see, if they keep the interest rates and the inflation too low, people are going to start to suspect something. But if they keep it too high, it ruins their scheme. So they make sure that silver, it follows their cycles and not the markets, which becomes very dangerous. And look, although I'm very optimistic about silver, I know that it hit a record high in 2011 at $40.50. But again, it's important to note that this is all because of the price manipulation and how these guys are doing it. While I am optimistic, it's not likely that this manipulation will stop. Sorry to say that. The thing is though, right now silver is at $25.79 an ounce. it's not a bad price, and this is an opportune time for you to keep stacking that silver. Because the more we keep stacking, the more physical silver we have, this becomes a big blow to the central banks because they can't manipulate it. Once everything is said and done, we still have the physical assets. Forget about the other stuff. And let's say maybe 20, 30 years from now, if the central banks come crashing down to a screeching halt, that's when silver actually pays up for us, which I think will be a fantastic investment. So we will win. Don't lose hope, because there's always brighter sides. What has the saying go? The grass is always green on the other side. Well, there are brighter days ahead. So keep buying silver and keep stacking it. And to help you out on the process, us at 999 Capital, we know that the financial system is deeply flawed and corrupt. It essentially makes you debt slaves and offers you no chances of making a better life for yourself. We don't do that here. We offer affordable loans to people who need it, personal loans, line of credit, installment loans, and payday loans as well, all backed by pure 999 silver, safe and secure. We follow all the policies from the Canadian Consumer Finance Association, so you can trust us that your money is in good hands. And we don't do any of that fractional reserve stuff, so no need to worry about that. But we're set to open at the beginning of September, late September-ish. So make sure you join our mailing list to be notified on all the great tips that we give out about silver, a lot of important information about that. And if you're one of the first 100 to open an account with us, you'll receive one free 1 ounce silver maple leaf dollar. Pretty cool, eh? So make sure you hit that subscribe button, click that like video, and click the website link down below to join our mailing list. Until next time, I'll see you in the next video.